Welcome everyone for an update on SKAGEN Global. We will talk about the portfolio holdings today and also give you a sense of a little bit of the market sentiment out there and answer any questions that you might have. So agenda, then we'll start with the market, then dive into the fund, and lastly then go into the final Q&A portion. So let's start to have a look at the market. This is when we take kind of a view around the world and we look at the total return up until and including the third quarter based in US dollars. What we can see starting on the left where we have the highest returns, Norway has been sort of leading for this group, largely of course driven by a very nice recovery in the oil price that has boosted many of the shares in that market. Then maybe going over kind of toward the right, emerging markets have had a tougher time. We have about -2% on that index, with the couple of the largest laggards being China and Turkey. And maybe just kind of for your information to remind you that when it comes to Turkey, it is an example of a market where SKAGEN Global has not had any direct exposure for a number of years, given that we have been concerned sort of about the overall political environment that the companies operate in. Hasn't seemed to be conducive to one that would, generally speaking, create a lot of excess shareholder value. China, as we know from the turbulence in the recent week, there's been a crackdown on a number of sectors by the regime, and that has of course scared investors. And again, China is a market where SKAGEN Global has not had any, doesn't have, and hasn't had any direct exposure in quite a while. At the same time, it's a big market, obviously. It's a big growth engine for the world, so it's of course hard not to have any type of exposure to the market and still participate in the overall growth. But the way that we as SKAGEN Global have chosen to gain exposure to select segments of the Chinese market is through Western firms, for example, the luxury goods companies, as well as Nike. These are examples of companies that we think are well run and that still can benefit from the overall wealth kind of build up among Chinese consumers and the development and growth of the middle class and the upper class as well, of course, for the luxury goods. So with that, then kind of moving on to the maybe more interest rate sensitivity part of the presentation. A lot of talk right now about inflation, and that is of course linked to what's happening, then also what are going to be the future actions of the central banks. Here is a map showing you what actions, if any, that the central banks have taken so far this year. Yellow, as you can see here in the legend, shows that nothing has happened. For example, in the US, there haven't been any actions to raise any rates so far. The pink or the red sort of tinted areas mean that rates have increased, and that has been the case, as you can see, primarily in South America and Mexico. And then we've had a few spots sort of left when there has actually been a rate cut. For example, here in Southeast Asia, there are a few blue areas. So a bit of a mixed picture, and something to that we will continue to, of course, monitor and to see what the impact could be on the stock market. With that, I mean, one thing that we hear a lot about this is, of course, inflation. Inflation has now kind of come up to establish itself as the biggest tail risk among institutional investors. This graph is taken from the monthly survey from Bank of America when they go out and they survey a few hundred global investors for their views on different aspects of the market. And as you can see from the graph here with the kind of navy blue, the dark blue on top, inflation is the biggest tail risk that have been identified in this survey. And I guess it goes also for August, where inflation also was the highest risk. Maybe worth noting that if you kind of move down the list, that COVID has now fallen in severity and it's now kind of down on third place. I guess reflecting in many ways that the pandemic appears to be subsiding, at least somewhat, in many countries. On the topic of inflation, there's of course a debate whether it's transitory or permanent. And just to kind of be clear, that SKAGEN Global doesn't take a view on this. I mean, we're not trying to make macroeconomic predictions, meaning that we don't predict what's going to happen to interest rates, inflation, currencies, GDP growth, and so forth. But we are instead focused on companies, the bottom-up fundamental analysis, and we look for companies that we think can perform well under a sort of a broad spectrum of different macro scenarios. Nevertheless, I mean, this debate is out there, and again, here's a graph from the same Bank of America survey showing that around 2/3 of the participants seem to think that the inflation is indeed transitory, whereas 1/3 take more of a view that it's going to be permanent. Time will tell sort of where we end up on this one. And our view, I mean, where we end up is, again, we don't have a firm view, but we do think that there are good arguments in both camps. I mean, clearly there has been a lot of money printing as part of the way to counter the pandemic impact. Hard to see that that's not going to have any type of influence sort of as we look forward. At the same time, I mean, on the other hand, you have that the pandemic has been sort of deflationary in its impact, in the sense that it has certainly accelerated any type of digital environment, digital developments that we think will have this type of disinflationary or maybe even deflationary impact in some ways. So the tug of war continues, and we think it's maybe too soon to write off any of the two sides completely at this point. Now, though, I mean, even though inflation is seen as a worry, we think it's sort of it's timely to also remind everyone that when inflation isn't what's causing the headlines and being a reason for people to maybe sell or think that the market has peaked, during the past decade, there have been many other big tail risks that at that point in time has sort of led to worries for investors around the globe. And here's sort of a good graph showing the S&P 500, the US index, which is a green line, and at the same time, some of the headlines from fairly well-known financial publications saying that the easy money has already been made, I guess implying that the party is over, it's time to sell. But as we know, the S&P has continued to climb and even kind of gone up past the 4,000 mark. If we kind of move forward to today's date, and it just kind of brings us to the fact. I mean, this concept or the view of trying to find safe bet, sure wins. I mean, that doesn't really exist in the stock market, even though that's what a lot of people kind of are looking for. And instead, the view, the mentality that we try to follow and take is that patience is sort of the key to this. And before we move on to the fund, just wanted to once again show this graph, which is an illustration. It's not the actual fund, but it is an illustration how we sort of think that the fund will perform over time, both in terms of relative and absolute terms, meaning that it doesn't go up in a straight line. There's no such thing in the stock market. It will be sort of two steps forward, one step backward, and we expect this type of shape to continue. And I think the past few years or couple of years have been a good example of how the fund has moved up and then fallen back a bit and then kind of got a renewed energy and climbed again. So that's the pattern that we expect to continue also going forward. So with that little intro, let's then move into the fund, and we'll start with performance. Here is our slide showing you the performance in the middle here of SKAGEN Global. You have the index on the right, different time periods, year to date, 12 months, 3 months, 5 years, so forth. The fund has had a bit of a tailwind and is ahead of the index on 1, 3, and 5 years. This is, by the way, all the return in euros for this time period. And obviously, we hope that we can keep up with this trend as we look forward. Even though it's not explicitly shown here on the previous graph, but we know if we look at the kind of a breakdown of the components making up the returns, meaning the split between stock selection, allocation, and currency, the vast majority of the outperformance has come from stock selection, which is what we aspire to do the bottom-up research and then have stock selection drive the alpha generation. That's true, by the way, both for 1, 3, and 5 years. Then if we move to the some of the names to look at kind of what has been driving the performance, starting with the best performers so far in terms of absolute contributors. We have Google, or Alphabet as a parent company is known, being number 1. Google has been a kind of a winner from the pandemic. More digitalization, more spend on ad, more online purchases. That has been good for the company. We've also seen a few reports now with the cloud business, which is a separate division for Google or for Alphabet, that has been growing and kind of emerged as the 3rd largest cloud player in the world after Amazon and Microsoft. So that's looking promising as well, and we see the market still having some doubts around that part, but we think that this is a good opportunity long-term for Alphabet and Google. Then we have DSV, the Danish logistics company. They are the freight forwarder, meaning that they don't really own a whole lot of equipment. They try to match shippers and receivers. Asset-light strategy. You have probably read about freight cost kind of ballooning, and yesterday actually we had DSV for the 5th time, I think this year, increase their guidance. So they've been doing very well, and that has of course been reflected in a very strong performance of the stock price so far. But we think that there is a lot more to go for if you take on a kind of a multi-year investment horizon. And then the 3rd best performer, Nasdaq. This is the operator, the exchange operator, but they also do things sort of in adjacent areas. They've seen good volumes for the trading, and they have been kind of hitting and even exceeding their organic growth targets by quite a bit. So that has been very positive for the stock price here. Then moving on to the bottom, Market Access, which is also a trading platform, but they do bond trading, and bond trading is still very much in an analog state, and there's a lot of room for that market to automate. Hasn't happened yet to a high degree here, but it's happening kind of slowly but surely. But so far we've had maybe lower than expected volumes for Market Access, and that has been reflected in a dip in the share price, but we think that they will come back here over time. Then the last 2 companies, kind of Finnish pulp and paper, UPM, reinsurer Munich Re. They've been in the portfolio only for a short period of time, so not really sort of a whole lot to comment on there. I mean, we know that the market has been going down for the past few weeks, and they have kind of been following the market downward to some extent. Then we also wanted to kind of say a few words about other things in the fund, given that we, like I said in the beginning, we look bottom up, very company specific, and when you own the fund, we hope that you're also interested in knowing what is happening with some of the companies and think that we think are maybe the highlights since our last update to you. One thing is Visa. You may know that we own both payment companies, Visa and MasterCard. They are both on the top 10 list, and And the pandemic has been, I mean, both positive and negative for these two companies. It has been positive in the sense that the shift from cash to digital has accelerated. I mean, to digital payments has accelerated. You can see in this graph sort of showing you the number of processed transaction, which is indexed to the 2019 figures. So I mean, what they were before the pandemic struck, and they have obviously been growing nicely over this time period when you kind of compare month by month going back to that index year. Likewise, if you look at the number of cards, credit card, debit cards, I mean, they are growing kind of mid to high single digits. That's also a promising sign, again, showing you the nice acceleration and continued growth in this, we think is a kind of irresistible force to go from cash to digital payments. So that's all good. However, what is less good or less favorable is the fact that there has been less travel during the pandemic. I mean, we know obviously about the lockdowns, travel restrictions, and that's sort of the same type of line down here at the bottom, the orange line here, showing you that, again, compared to an index of 100 in 2019, we are quite a bit below the index here, even though it's on a positive trajectory, but still it is down a lot, and that is important for Visa, because when you use your Visa card internationally, then those payment streams tend to be extra lucrative for the payment companies. So less people traveling, less cross-border transaction, less payments to these companies, and that has been negative, and probably the main reasons why the share price have sort of plateaued and not done a whole lot over the past year or so. But I mean, again, we think that this is a matter of time when it's going to come back. We're not politicians, we cannot predict when travel restrictions will ease, but with vaccination rates being pretty high in many countries, we think it's more a matter of time, and once that happens, then the beautiful and very cash generative business models will sort of kick in and hopefully provide a nice boost to these payment companies. The Nike, another name that we have in the fund, a company that is benefiting from the kind of health conscious trend that is sort of spreading around the world. And Nike has been benefiting and executing well on the initiative of basically going direct to consumer. The direct to consumer initiative means that they are in a way circumventing third-party sellers, and also means that they can have higher margins on those sales. So that's positive for Nike. What has been maybe a bit of more of a blip or a speed bump lately has been that Vietnam had some big shutdowns in the past few months, meaning that supply has been constrained. Demand has been very high for Nike, but they haven't been able to quite meet that demand, given that it has been sort of stopped in the production facilities. But we think, again, this looks to us like a very transitory, temporary measure that will kind of correct itself. Speaking of kind of the importance of sort of being patient, and Nike is a good example here that the stock has, as you can see on this chart, which goes back to 1986, had a number of periods when it has had drawdowns that have been significant. A drawdown is essentially, I mean, the percent that a stock goes from peak to trough before it picks up again. And if you invested in 1986, you've had a number of these sort of drawdowns that have been scary, probably at times, happen to you. The good thing is that if you invested in 1986 and you were able to stomach the drawdowns, and you sort of saw that Nike was continuing to execute and grow, then you would have reaped a very nice return over that time period. In fact, an investment of $10,000 in 1986 has turned into more than $10 million in 2021, roughly 20% CAGR over that time period. So this is an example of investments that we try to find for the portfolio. Of course, investment that we can find before they can go all the way, but that we can continue to kind of surf the wave. And even if there is sort of short-term blips, speed bumps, and they can be, easily kind of 20-30% drawdowns, if fundamentals look okay, if valuation is still supportive, we tend to hold on, and then most of the time we see these companies tend to recover. And the last kind of part I wanted to bring up here was ASML, which is the Dutch company producing extremely advanced machines for semiconductor production. This has been in the newspapers given that there's been a clear shortage of memory chips. And here in ASML, they have more or less a monopoly on these type of machines that are used across the globe. They had a capital markets day. They kind of went through the case. It is very much in line with what we had expected. And we know that there are good, solid fundamentals for this case. A lot of kind of trends supporting the use of more chips. We know people get connected more and more devices per person, and in businesses being hooked up to the net. These are things that they will all, to some extent, use chips, and ASML, again, they have that monopoly, which we sometimes kind of think of as the ones producing the spades or the shovels. If you have a gold rush, you don't have to bet on exactly which company of this technology ecosystem is going to be the big winner. Most of them will, to some extent, use something produced by ASML. So we like the company. It has performed well, but we still see a considerable upside when we take a multi-year view on the stock. Then back to the fund, the portfolio. What has changed? Well, during the first 6 months, we didn't buy any new companies. In the past quarter, we picked up 3 names: JP Morgan, UPM, Munich Re. JP Morgan, one that we have held before. We see it as one of the best run banks in the world, where they are especially tech savvy, so understanding the importance of investing in technology. Finnish UPM, pulp and paper company that is transforming into a company with product focus on adjacent areas with better margins, better returns. And then Munich Re, where we hope that the company can be able to take advantage of the increasing prices in the insurance sector. So those have sort of entered. What is out? Last time we spoke, we talked about McDonald's and Mars, so I won't bring them up again. And we also offloaded the small position we had left in the US chicken producer Tyson Foods, given that we had more attractive alternatives for the portfolio. Then slide 31, we will look at the breakdown sort of by sector. SKAGEN Global in blue, index in green. And as you know from before, we don't always have exposure to all sectors. We still don't have anything in energy, nothing in utilities, nothing in real estate. We do have overweights in financials, in IT. And as we have said before, we make our own assessment of which sector we think companies should be in, and that may or may not agree with what MSCI says. But in the case of financials, yes, we have an overweight here, but we don't necessarily think that the companies in here like Nasdaq, ICE, Moody's are pure financial companies. We actually think that they may better be placed in other sectors. But that's just how the index sort of chooses to categorize them. Similarly for IT, here we're not too worried about having sort of an outsized exposure to one sector, because what we own, Visa, Intuit, Adobe, Autodesk, ASML, they have very different underlying driving forces, whether it's payments, content, tax filings, semiconductors. So again, we're not overly worried about having a high sector concentration in IT at this point. On our top 10 list, it looks like this. You've seen it before, and we often talk about some of the cornerstones of the strategy. They include having a competitive advantage, having strong balance sheets, and of course be undervalued. And again, when we kind of show the numbers, we think that they back up our qualitative thinking with operating margins being a lot higher for our companies, ROE being a lot better, balance sheets, as you can see here, whether you look at net debt to EBITDA, interest coverage. Our companies have, in general, very strong balance sheet that would help them to withstand in case there is some type of sharp correction in the market. And then last but not least, of course, companies have to be undervalued. When we look at the price targets, which is the price target that we have for them, looking sort of 2 to 3 years out, on a portfolio level, we're at about 35% plus upside, which we think is pretty attractive compared to kind of where we have been in historical terms. That gives us confidence in good performance also when we look forward. Then there's been a couple of questions that have come in, and I will sort of take them one by one. The first one is about the yield or the interest rate levels, where the questioner is basically asking if the yield plateau will lead to sort of changes in which fund and strategies maybe perform going forward. The way that we think about this question, the way that we have interpreted the question, is that the yield plateaus sort of refer to, as you can kind of see from these graphs from different countries, that interest rate, kind of the fall in interest rate has kind of stalled out and to some extent stabilized at a relatively low level. More specifically, these graphs kind of show you the 10-year government bond yield by country. And sure, like over the past sort of few years in most countries, they are now at a fairly kind of stable level. Sure, they may fluctuate by tenths of bips, 0.123% up and down here, but we haven't seen any big changes over the past 5 years in most of these yield curves. Well, what does it mean? I can only speak for kind of what it means for SKAGEN Global, and in our case, it doesn't really mean a whole lot, given that we are so focused on the companies, and we are not trying to, again, make a prediction if rates are going to go up, stay on the plateau, or go down looking forward. Our companies should be able to, again, sort of live and thrive in most environments. If it turns out, of course, that there's something fundamentally changing that would drive interest rates higher consistently, then we're going to embed that in our analysis, but we're not going to try to front run it and make those type of macro predictions. That's not the game that we are playing. And the second question is about the year-end prospects for SKAGEN Global. Can the current momentum be maintained? And well, I guess when we look in our crystal ball, what's going to happen over the next few months, we don't see sort of a whole lot that gives us any confidence that we can predict the market. Again, we don't know how the market will react. We don't, and to back that up a little bit, if you look at this graph, you can kind of see that it is the index, the MSCI All Country World Index, showing you the monthly return by year, going back 10 years. And to us, it looks pretty much like a random walk. And what it's going to look like here, October, November, December for 2021, we don't know. It may go up, it may go down, it may be flat. And that may not be a very satisfying answer, but I think that is going to reflect how we think that we don't have any ability to predict the market kind of on a 2.5 month view. But what we do think, though, is that over time there is still good upside for the stocks in our portfolio. And when you take the longer term view, we know that over the past 10 years the total return has been attractive, I mean, higher than the long-term historical averages for the global market. And we think that there is sort of a good chance for anyone who takes that long-term view to continue to reap good rewards. In fact, if you go back and look at S&P 500 back to, I think it is the 1870s, so about 150 years, and then you go forward over kind of rolling 20-year periods, there has never been a 20-year period with negative return. Now, thus, of course, looking backwards, it may change as we look forward, but we are still optimists when it comes to prospects for long-term investing, at least based on what we see in our fund and the companies that we have in our portfolio that we think will help drive and deliver that return. Many of them you can see on this slide, and to us they look well positioned to continue to deliver that return for the fund unit holders. And before I pass it back to Ole Christian, I will just sort of end with this slide, which is kind of how we think about the SKAGEN Global maybe fitting into a bigger portfolio. Obviously, each and every one will have kind of different personal circumstances driving what you invest in, and there are many different examples to diversify a portfolio. But we think and hope that there is room for SKAGEN Global to be, in a way, sort of a kind of provide a foundation in that type of long-term savings portfolio, one that can consistently deliver attractive returns over a long time period. And with that, I will hand it back to our host, Ole Christian.
Thank you very much indeed, Knut, for that thorough presentation. Now we have a question here. We've seen the Visa case that you presented, and one of the viewers is wondering, does it not seem like a risk to be invested in Visa, considering the bloom of alternative payment technologies that are appearing in Asia, Europe, and North America?
Yeah, no, it's a good question, and a couple of things to say to that. I mean, first one being that there is a risk in every investment case. I still haven't heard of a single investment case when there is no risk. And in Visa, that is of course one of the risks. That is true that competition could be picking up and somehow try to displace the incumbents like Visa and MasterCard, and we take that risk very seriously. And to maybe dive into some of the other things in that area. Looking at Asia, I mean, we know that the Chinese market is essentially closed to outside payment, and probably to a large extent there's limited ability of the Chinese payment companies to venture out far beyond the Chinese borders as well. So that's kind of one thing that at least puts a bit of a damper on that type of competition. What's maybe more or bigger risk would be the fintech companies that have emerged here, and we know that there's been a number of them coming up here during the pandemic. But here we have the fact that Visa is not really competing with them sometimes. I mean, they are more partnering with these companies. There have been several examples when these payment companies have maybe initially thought that they would compete with Visa, but then at the end they partner instead. And these payment companies, they provide some type of overlay, but the underlying transactions continue to go on Visa's payment rails, which is kind of the plumbing of the global payment system. So what we can see so far, there hasn't really been any type of strong indication that Visa would be losing market share due to these other players. In fact, they seem to be actually becoming even more ingrained in the overall payment system. So to summarize, I mean, we're not in any way complacent about this. We think it is probably the most important risk to keep an eye on, but what we have seen so far hasn't led us to reevaluate the case and think that it would be something that could break the investment hypothesis, at least not as things stand currently.